Good evening, everybody. My name is NERU PADMANABHAN. I am the Director of Engagement at Public Allies, Inc. And today I join you with Michelle Herscu, and we're here to bring you an amazing webinar. Just before we do that, I want to introduce Public Allies. Public Allies, we're a nonprofit organization. We're an educational platform. And prior to COVID, we did a lot of programming for seniors, nonprofit organizations, our community at large, and we helped a lot of battered women, and we ran a lot of support programming for vulnerable individuals. But when COVID hit, it hit us with a new opportunity, and we got the opportunity to bring you new educational forums on Facebook Live. So this is our major platform, and as we did that, as we brought you new and unique information, education, we realized that we were really helping people change their views. We were helping relieve stress. We were helping relieve anxiety by providing education on topics that really make people feel cornered. So the best equalizer, we believe, is education, is a universal equalizer. When you are educated on a topic, you have more information and you have more vantage points, and you are able to make a decision based on all of the things that you know. So Public Allies Inc., week after week, we bring you new webinars, new roundtable discussions, and new interviews with amazing people that help bring you insight on unique and elaborate topics. So this week, we're going to be talking about business finance. And today is September 30th. September 30th for us in Canada is Truth and Reconciliation Day. And today we celebrate those and we pay homage to them that were in residential schools, that were victims in burials, in unmarked graves. And we pay the best respects to them through Public Allies as individuals. And the best way to help, as I've heard, is just listen. Be the best community member that you can be the best partner that you can be to a community and to individuals that are in pain, that are hurting. Lend your hand of support, ask how you're able to do it, ask how you can be a better community partner. And that's what we do at Public Allies Inc. Today, our executive director was out with her community within Indigenous or celebrating Orange Shirt Day. So thank you again for joining us for this wonderful webinar. And I always forget to introduce myself properly. I am NERU PADMANABHAN, the Director of Engagement at Public Allies Inc. I'm from a mental health background, but recently, about 2.5, almost 3 years ago, I decided to get licensed in finance. And the reason I did that is because a lot of the clients on my caseload were regular people like you and I. And they got hit with some type of tragedy. They didn't have enough information. They didn't have enough education. So they lost out on the financial ability to take care of themselves, and they ended up on my caseload. So there's millions and millions of people out there with lack of financial education. So here, Michelle and I are to educate you on this topic. Go ahead, Michelle, introduce yourself, and I'll bring up our slideshow.
Thank you so much, NERU. What a lovely introduction, and it's very exciting to be here tonight. I appreciate you coming, you watching, you listening. We're gonna spend some time talking about some really valuable information. And before I start, so really quickly, my name is Michelle Herscu. I'm a CPA, and I own an accounting firm, MLHC Professional Corporation. And I think we can get started, right, NERU?
Yeah, go ahead.
Okay, perfect. Okay, so just really quickly about the services that my firm provides. There's business advisory, virtual CFO services, tax filing, monthly bookkeeping, accounting review, and quarterly checkup. And before we dive in, I always like to read out loud a very quick disclaimer that the information that we provide today is really intended for general purposes. It does not take into consideration your personal situation and is not intended to be used without consultation from accounting and financial professionals. Michelle Herscu, myself, and/or MLHC Professional Corporation will not be held liable for any problems that arise from the usage of the information provided in this webinar. Thank you. Okay, so what are we going to cover tonight? So tonight we are going to talk about HST, GST, quick overview of personal taxes, business tax, so sole prop versus corporation, common business deductions, business use of home expense, that's a topic that comes up a lot, a little bit about bookkeeping. Then I'm going to switch over to NERU, who's going to teach us about Finance 101, very, very important information. Then a quick summary and Q&A. Okay, so let's start with the GST HST. Really quick question. Did you know that you can actually register voluntarily for GST HST? You do not have to wait until you hit the threshold. So what is HST? It stands for Harmonized Sales Tax, and GST is Goods and Services Tax. So as mentioned,
Oh, sorry about that.
That's okay.
Oh, sorry, technical difficulties.
That's okay. We're just testing everyone's knowledge right now.
Go ahead. I'm so sorry.
That's okay. Okay, so really quickly, this is HST is combined federal and provincial tax. And in Ontario, it is 13%, whereas the rest of the provinces that do not have GST are at a 15% rate. The GST is only the provincial rate at tax of 5%. And these, the provinces in brackets are the ones that charge the 5%, Alberta, BC, Manitoba, Northwest Territories, Nunavut, Quebec, Saskatchewan, and Yukon. So when is it really mandatory to charge HST? It becomes mandatory when you actually hit 30,000 in sales. And one thing that I want to make clear is that this is $30,000 from sales of your business. So not your, let's say you are still working full-time or part-time, so you're getting a T4 from your employer, and you also have a side hustle. So the 30,000 for the calculation only pertains to the sales from the business, okay? So not the income combined from your working as an employee plus from like employment income plus the business, okay? So just the business. In terms of the calculation for the regular method, the way we would do that is we would take the HST, the sales tax that you charged on your sales, and deduct from that the taxes that you paid on your expenses, also known as ITC. If the balance is over zero, then that means that you actually have to remit the difference between these two numbers to the government. If the balance is below zero, then that means you actually are supposed to get a refund. How do you register for HST? So really there are three main ways to register for HST. You can do it online through your business account. You can do it over the phone when you call CRA. It's a very quick process. Or you can mail in fax, which I do not recommend. So either the first method or the second one. Pay attention, you do need some important information before you register, whether it's online or over the phone, that you will be asked that information. The effective date of registration, the fiscal year, the total annual revenue, and if you are registering voluntarily and you don't know what the annual revenue is going to be yet, then just give an estimate. And then they would also ask you for personal information like your SIN, date of birth, and postal code. In terms of the filing and the payment deadlines, so the sales tax filing is annually. The requirement is annually if your business revenue is under $1.5 million. It should be done quarterly when your business revenue is between 1.5 and 6 million. And if it exceeds 6 million, then it's going to be monthly. In terms of the payment deadline, one thing that I really want to clarify, and not a lot of business know that, but if you owed more than $3,000 in total for sales taxes last year, then you would actually be required to make quarterly installment payments this year towards the HST filing for the current year, okay? And you would base these quarterly payments on the amount from last year, unless you can estimate for this year if it's more or less, then pay accordingly. But make sure you are making these quarterly installments. In terms of late filing, so CRA actually charges 5% annual interest on any outstanding balances, plus 1% for each full month of your return when it was late. So just keep that in mind. So quickly talking about personal tax returns, credits and deductions. So credits are really tax savings that are based on the lowest tax rate of your province, and these come off the owing tax balance. Some examples, which I'm sure you've all seen, are the basic personal amount, the age amount, tuition credits, disability and medical expenses. And then in terms of deductions, these are tax savings that are based on your marginal tax rate. So these reduce your taxable income. Some examples would be like RSP, childcare expenses, professional dues, and moving expenses. Excuse me. In terms of filing and payment deadlines, so it's a little bit backwards because the for people who only have employment income, the filing and the payment deadlines are the same, April 30th. But for sole proprietors, the filing deadline is actually June 15th. However, if you do have an owing balance, then you should be paying that before, on no later than April 30th. Okay, so just keep that in mind because it's a little bit backwards. So always just make sure that you really take advantage of all the possible deductions and credits available. And we actually my firm provides a checklist of all the documents that need to be provided so that you really cover all the applicable credits and deductions. A little bit about business tax returns. There's really only two options. It's either the business income that you're going to report as a sole proprietor or the business income from your corporation, which are both of them are reported separately and differently. So what is the T2125? This is a statement of business or professional activities for sole proprietors only. So this is used for reporting business income and expenses for sole props and partners in a partnership, and any person with additional income must report it on the T2125. So even if your business is not registered, you still need to fill out the form and report the income. And you will need a separate form for each business in case you have 2, 3, or more than that. This is just a screenshot of how the T2125 form looks like. It has about 6 pages. This is just the top part of the first page. A lot of the times I get asked the question, how much money to set aside for tax purposes. So really what I say is in terms of GST and HST, basically anything you've collected as GST or HST, just put it aside in a separate bank account, like a savings account, because this money is not yours. This is definitely the government's money, and you don't want to get to a point where you have to do the GST, HST filing and you don't have the funds to pay. So definitely do not touch these funds, just set them aside. And in terms of the income tax, this is really based on your personal level. when you look at the overall income from the business and the personal, I usually recommend to put 25 to 30% of each invoice that you send out. And this is because in terms of employment income, you would usually pay all the taxes already by your employer, who will be liable to remit all of these government taxes, CPP, EI, etc. In terms of the corporate tax return, so this is reporting the activity of a corporation. So if you owe a corporation, you would be required to file something that's called T2, Corporation Income Tax Return. This is a screenshot of the first page, usually about 40 to 50 pages per return. A little bit about tax credits. These would be investment tax credits and SHRED. And then tax deductions would usually be the small business deduction. There's something that's called CCPC in Canada, and that stands for Canadian Controlled Private Corporation. And these are the ones that really qualify for the small business deduction, which is a lower tax rate on the first $500,000 income you've made. Usually for Ontario, it would be 12.2% on the net profit. And again, same rules in terms of how much money to set aside, but there is an additional tax layer, which is the corporate income tax. So that's another one you should consider. As per my previous slide, you need a roughly 12.5%, 12.2 to save out of the net profit to remit the corporate tax. So again, 13% of sales for HST, if that's what you've collected, 13% or 5%, 30% of income for personal income tax from the invoices, and then the 12.5 of income for corporate taxes. So again, another popular question is, what are some of the common business deductions? And before I talk about that, just a really quick definition of what is a business deduction. So really, this would be the cost that you incurred to earn business income. And it's needless to say that personal expenses are not considered deductible business expenses, so do not put that Netflix charge on your business expenses. Okay, so really quickly, let's review the common deductions. So this would be, for example, advertising, business startup costs, annual license fees, delivery insurance, interest and bank charges, legal, accounting, any other professional fees that you've paid, maintenance, repairs, meals and entertainment, which by the way are only deducted at 50%. Office expenses, property tax, rent, salaries, supplies, utilities, travel, and mileage. Okay, let's tackle the business use of home expenses. Again, a very popular one that keeps coming up. So there are really two conditions to be able to qualify for that deduction. So it's either your principal place of business, okay? So you would have a designated space at home, which is your home office, or you use that space only to earn your business income, and on a regular ongoing basis, you meet with clients or patients. What are some of the allowable deductions that you can use for your home office? So it would be the heat, the home insurance, electricity, maintenance, property tax, and mortgage interest. There's two calculation methods that apply. I personally prefer the first one because it's straightforward and easy, or easier. So really you would divide the area of your workspace by the total area of your home. So if, for example, your office space is 200 square footage and your entire home is 2,000, then that means you can deduct 10% of the total expenses as business use of home expenses. The other method is that if you use the space personally as well as for business, you would calculate how many hours are for business purposes, divide by 24, and then use this ratio to multiply the total costs by. If the space is used for part of the week, then you will also need to reduce your claim accordingly, okay? So that's why I say, just make sure you have a designated space at home that you only use for business, and then just use method number 1. What is bookkeeping? Another popular question. So it is the recording of financial transactions, such as incoming cash, deposits, bank reconciliations, collect and remit sales tax, and manage AP and AR. Do you really need to do your bookkeeping? So, like I said, short answer, yes. Why is that? Doing the bookkeeping really helps to keep your books up to date. It definitely will assist you if you ever have a CRA audit. You should know how much HST, GST is due and prepare accordingly. You will be able to identify duplicated or missing payments and also plan for the future by knowing your current numbers. Very, very important. So final tips for getting ready for tax season. I know it's next year, but it's not that far off. So really keep all your invoices, slips, and receipts. My best recommendation is to go digital. There are many online applications today that allow you to scan and save this information, because you cannot claim what you can back up with proper documentation, and a credit card statement is not enough. Make sure you have the receipt. Categorize all the information. Why do I say that? So number 1, you will have better control over what's going on during the year. So you would know that you had X amount of expenses for maintenance, Y amount of expenses for rent, etc. And number 2 is for me. If you want an accountant to file your taxes, then it will be way more efficient with better results, because this way we know that everything is kept in a very organized manner. Have last year's filing and notice of assessment handy and ready to go. These are really the starting points for a new year filing. And create a CRA account. You can make changes to information. You can file GST and HST online, review reports, ensure you do not miss any important correspondence from CRA, because you can sign up for emails. So thank you very much for listening, and I'm happy to present NERU now. So NERU, the stage is yours. Thank you.
So as we do that and we go forward, I just want to take you back up here to wonderful Michelle Herscu. I cut you off while you were doing your introduction. Michelle is an amazing individual. And as we go through the slides, I want you to introduce yourself properly, and talk a little bit more about the other endeavors that you're partaking in and how you're helping business individuals level up. So go ahead, stage is yours again.
Oh, thank you so much, Nero. I appreciate it. Okay, so my background is more in the corporate world. I was actually, my last position was as a CFO of a construction company. I have more than 15 years of experience in the finance world, and I decided to start my accounting firm because I really, really wanted to help way more small businesses, very similar to you, Nero. In the sense that we have so much skill and knowledge and expertise, and for me it's important to just help, you know. So if it's answering questions, if it's helping by answering a phone call or an email, anything we can do to make the life of the business owners easier, because it's really stressful to run a business, especially as it starts growing. So one of the other services that I have, which I absolutely love doing, is business advisory. And I always tell people it's not just only about the taxes. Like, really, taxes is the last thing that is like on the list. Yes, it's important, of course, the compliance, you have to do that. There's no doubt about it. But if you want your business to grow in a healthy way, you have to be able to look at the numbers on an ongoing regular basis, which means every month we would meet, sit down, review the numbers, talk about the performance, talk about the goals, talk about what you want to achieve. And like NERU is going to show us very shortly, the business and the personal always go hand in hand, right? And as a business owner, you really have to make sure that you have that planning in place. And again, it's not just about the taxes. It's really understanding your margins, your numbers, your performance, and knowing what are the next steps that you need to take from an accounting and operational perspective to get from point A to point B.
Yes, and that's absolutely amazing. Sorry for cutting you off earlier. And Michelle is 100% right. It's more than just your accounting. Receipts, things that you feel that you made a mistake on and you're having anxiety over, things can be redone, they can be fixed. There are ways to mend things like that. And there's people like Michelle out there that are going to help you with all of those transactions. So again, my name is NERU PADMANABHAN. I'm a licensed financial professional. And as Michelle and I discussed, we all have our reasons for why we do what we do. And it's all about moving our community forward, moving the individuals forward, and and stopping the mistakes. So I think it's a motivational quote: learn from somebody's mistakes. And the best mistakes that you can learn from are the people that don't do so well in their finances, that have had CRA audits. And that's where you learn how to really keep up your books, keep up the information. And when you're learning about finance, there's several areas to learn about, which they're not too hard. Once you get a hang of all of this, it's smooth, it flows. It's like butter. It's not too hard at all. So today I'm going to be covering insurances, and I'm going to be covering understanding your debt differently, investments, RSPs, and RSP loans, and how this all flows together. So when you're looking at your finances, there's major areas in finance. So first is understand your cash flow. What's going in, what's going out, creating emergency fund, proper protection, building wealth, preserving that wealth, and looking at your debt management. And none of these things are done without the other. They're all done in conjunction to each other. And I know a lot of people say that I'm going to focus just on my debt and I'm going to relieve that debt and I'm just going to snowball it. It is an amazing strategy. But even while you do that, you can still save and you can still put aside and protect your family and build your wealth and learn how to preserve it. So as we discussed a lot about business today, business finance is so important. And it's one of the areas that gives people the most amount of anxiety, especially if you just opened up a new business, if you just started side gigging, freelancing, and you're just getting money from different places. When you're self-employed and you're getting a check here and there from financing, from freelancing, side gigging, from a place that you just opened up, and you're not quite registered, you don't know what's going on, contact somebody like Michelle. She'll give you the right information. And when you're doing that, you're called self-employed. So self-employed individuals, your business is just an extension of your personal finances. So that's when you have your personal finances protected. You have your insurance, savings, debt management, you have your investments, diversified, preserved wealth, and you have your estate planning all in place. And your business has your business overhead expenses, your write-offs, your business accounts, your business credit cards. You have all of those things in place, and those get written off against your business income. So when you're looking at side gigging, you're looking at businesses or sole proprietorships. This is how it works when you're self-employed, just an extension. But when you own a corporation, it's almost like you're an employee of the corporation. You guys are separate entities. Legally, your corporation is really well protected. But even though your corporation is really well protected, I want to remind individuals you can still get into trouble personally. And it doesn't mean that your corporation is bulletproof. Stuff happens, so make sure that you protect yourself. And the first thing always is is make sure your personal finance is in order. You have your insurance, savings, debt management, your investments are diversified, and all of the same things always fall into place. And the same for your corporation. Make sure your corporation is protected. It has separate accounts. You're filing your taxes very specifically. And Michelle's already gone over a lot of that stuff, so I'm not going to go over it too much. So making sure your personal finances are really in order in both sides. When you have your corporation, you have a little bit more protection. When you have your sole proprietorship, you have a little bit of protection. So always making sure that your protection is always there, and you can do a really good job of protecting your personal finances. So what does that start with? It starts with insurances. So why insurance? So insurance can help you pay off your debt, replace your income, give you peace of mind, pass on a legacy to your family or charity, and then it's tax-free money, and you bypass probate. So probate is the provincial taxation process when you pass away. And I've heard, I haven't had it happen to me, but I've had people that have gone through that probate process when they've lost a parent or a spouse, and they said it's not an easy process always. So it's when your taxes, when your finances are protected properly, the taxes go through easier, everything is finalized really well. So insurances actually bypass all of that. You get a check directly from the insurance company, and none of those things actually apply with probate, and it's non-taxable money that you receive. So insurances protect you and the people that you're leaving behind. So when you look at insurance, there's two major types. There's term insurance and permanent insurance. Term insurance is like renting. It's cheaper up front, so it costs a little bit less, but it's really expensive the older you get. And a lot of people buy term insurance thinking it's cheaper, but they kind of outlive it. And at the end, you do not receive anything from that money. And the second type of insurance is permanent insurance. So it's a higher cost up front, but it's like owning your insurance. So it's insurance and investments. Investments grow completely tax-free. They pass that probate process, and your investments can grow within that lifetime, and you can actually access it. So you can access that cash value and actually use it. So the other part of insurance is also called living benefits or income protection. So that's called disability insurance, critical illness insurance, business overhead insurance. So this type of insurance protects you in case you get sick or hurt. It makes sure the rent is paid, the lights are turned on, your employees are paid, your family is taken care of. Because oftentimes it's not just about us passing away, it's about life happening. So a lot of people that you send up on my caseload was when life happened. Cancer patients, individuals that hurt themselves, construction workers, people with crippling arthritis. A lot of people live through that, and they live healthily to that, but they have a period of time where they're unable to work. So this is the benefits that protect you. And when I sit down with a lot of people, they still find that it's not as useful to them, but I help them understand. I always explain why they are so important, and you'll still have people saying, no, I'll be okay. And you always hope that they are okay. And business overhead and health insurances are to protect your business and also yourself. If you're a sole proprietor or you're a corporation, is somebody have a health plan? Does somebody have a medical plan where you're getting money back, Manulife, Sun Life, anything like that, a Blue Cross that covers your health benefits? So that's where you're able to purchase it on your own. And a lot of times when you're purchasing it for your business, they are write-offs in a lot of ways. And then secondly, we want to cover cash flow, understanding cash flow, debt, and savings. So when a lot of people look at debt, they think that debt is always falling the other way. Debt is heavier and savings is a little bit lighter. And I know a lot of months people fall into the red. But when you're trying to understand your debt, try to figure out where that debt is coming from. Look at your cash flow. Look at the interest rates. Look how long that period of paying off paying off the mortgage or your debt is. So most times debt is in credit cards, it's in loans, it's in mortgages, it's in student loans. So certain types of debt are better than others. When you have mortgages, you're paying it down because you have an asset. And when you have student debt, it actually gets written off against your income. So I have a lot of people that take a lump sum of money and they say they want to put it on their student debt. And I say, well, your student debt actually decreases your income. And it helps you get a return back. And if you're going to take all the lump sum of money that you have, you're only paying a small amount of interest on it, and your money can actually earn more interest if you invest it in a proper place. So it's just learning about the tricks and tools of consolidating debt, putting in the right places, seeing if your debt can fall into your mortgage and you can pack it up in a neat package and pay one monthly payment versus paying multiple payments. So there's so many options out there. And when you look at your savings, it's about creating an emergency fund, investing, having short-term savings. And sometimes this budget is $30 per month. All you need is to do it slowly and surely. Debt gets paid down slowly and surely, and savings are done slowly and surely. Always have a goal in mind. What's my final goal? And once you put your final goal down, then your savings plan and your debt plan start to make a little bit more sense. And when you look at that balance in terms of your debt, you want to look at your short-term and long-term savings in terms of your goals. And emergency fund should also always be liquid. So liquid means that you're able to access it quickly. So for example, oftentimes a TFSA can be liquid, and it could still be invested in something, but you're able to get it sooner than later, within 7 days or so. And if you have something that you haven't invested in, if you have your emergency fund sitting in certain types of investments or certain places in homes, is not liquid. You have to sell a home, you have to sell an asset, and it takes a while to get that. So always make sure you have a small amount of money set together, 3 to 6 months of your income, set aside somewhere in case there's a rainy day, in case something happens, plumbing issues, stuff happens, life happens. So it's so important to have that set aside for yourself. And when you're looking at it, understanding debt, I love talking about this particular rule, and Michelle also smiles as well when I talk about this rule, because understanding it has changed the way I look at finance. Finance doesn't look as hard anymore because I understand the rules around it. And I know math professionals out there will totally love this, but the rule of 72 is when you divide your rate of return into 70 years, 72, it gives you the number of years it'll take your money to work for you or against you. And I really want to say that I invented this, I came up with it, but it's not me. It was Albert Einstein who gave us these genius numbers. And let's give an example of how this actually works. So the average credit card rate in Canada, Michelle, do you know the average credit card rate in Canada?
Yeah, I do. That's actually exactly what you have there on the screen.
19.99%, but I've seen credit cards like those Tim Hortons cards. Some of them are 25.99. The Bay card is, I think, 29.99. So there's credit cards out there that are not always 19.99%. Know the credit card rate that you're going, but the average credit card is 19.99. So if you divide 19.99 into 72, your money is going to double against you every 3.6 years. I recently met a client who had a payday loan, 47%. So that will double against you in 1 year. So you really have to check, what are the rates? What are you signing off on? Try to understand where that money is actually going. So when we look at it, say, for example, you have a $30,000 credit card debt, and average Canadians getting out of college, $30,000 in credit card debt is not uncommon. and say you have it on a 19.99 credit card, and you apply the rule of 72, and you really look at it, $30,000 is your original balance. In interest paid, if you make minimum payments, you will actually end up paying $34,981 in interest. So you actually pay more than you get, and it's going to take you 109 months to pay that off. I think that's close to about 10 years. So when you're looking at your money, see how interest affects you. Understand your debt, savings, and think about what you could do with $34,000 additional. So say, for example, we have the same $30,000 at 6% or 2% in a mortgage. We have some great mortgage rates going on right now. And say, for example, $30,000 at 6%, you pay it off within 6 years, minimum payments, and you pay $4,608 in interest versus the $34,000. So you're actually saving $30,000. And say we take it even further and we say 2%, you pay $1,350 in total interest. And even though it's not 58 months, you pay that off in 53 months. So you save yourself so much money. So these are just some concrete examples of how understanding interest and the rule of 72 can work for you. And the same thing goes for when you're investing. So when we look at investing, I just want to go over some investing 101 rules. So a lot of people don't understand what are the places that you can invest in Canada. Those are guaranteed income certificates. And when you talk about those GICs, a lot of countries have GICs, but they'll have different rules. In Canada, high interest is about 1%. So most GICs will be about 1 to 2% maximum that you'll earn. And I know in countries like India, Venezuela, I've heard that the GICs earn so much more money, but the truth is it's because inflation is so high there. So inflation and interest have a relationship. They're like cousins. I think Michelle can explain the relationship way better than I can. I like GICs. They make sense in certain situations. But one situation they don't make sense in is because a lot of times they're locked in. And when money is locked in, it's not liquid. You can't get access to it. And oftentimes these contracts are really solid. Sometimes you can break them, but it'll actually cost you more money to break them because you're in a contractual relationship with the bank. So you want to really make sure that when you're doing a GIC that you don't need the money for that period of time, and you understand that your money is going to be going below inflation. So inflation is the rate at which cost rises, and your money is actually growing below that. So the second way is bonds. Bonds are when you partake in growth of a company. They're medium risk, they're medium return. Countries have bonds and companies have bonds. So Apple and Canada both have their own bonds, and you're able to get it, and they're medium risk, medium return. The one we know the most about is stocks. The stock market, it's high risk, higher potential for return, but it's harder to diversify in the stock market, especially because certain stocks are really expensive. So for example, if we take a Visa stock, it's about $268. If I have $500 to start investing, I'm not going to be able to go very far with stocks. So really watching your budget. And lastly, it's the best of all worlds, which I like to call it, is investment funds. So investment funds are ETFs, EFTs, mutual funds and segregated funds. And it's managed by professional money managers. They're diversified. They have downside protection. So in case they end up falling, there's always some ways to pick them back up because the money manager is looking after them and they have higher returns. So when we look at mutual funds and we look at segregated funds, I really want to outline that there's some differences, especially when we're talking about business. Mutual funds are not creditor protected. There's no protection on your amount. There are lower fees though. So that's why a lot of people like them, because they have a mix of bonds and stocks, and they have that protection where you have a money manager possibly looking after them, and you can get protection from both sides of the market. So when stocks are high, you can get stocks. When bonds are high, you can get bonds. But there's a lot of fees attached. So there's transfer fees, redemption fees, professional fees, and they're subject to probate. So that provincial tax, when somebody passes away, they don't just pass along freely. They actually have to go through that probate process. So you don't have access to the money as quickly and as readily. Versus segregated funds, they are creditor protected. So say, for example, we were talking about protecting your corporation and your personal taxes. Segregated funds have way more protection. And they're guaranteed on principal amount. So you can actually guarantee about 100% of your principal amount. But naturally they come with a 75% protection. So say the market falls and you have $10,000 in there, $7,500 will be protected, and you won't have to worry about that. There's no fees on transfers, redemptions, or professional fees. However, for that protection, you're paying a higher fee. So they do have higher fees on them, but as you've heard on TV, on those commercials, fees aren't everything. You have to look at your net return, and you have to look at, do you want to take the trouble on of managing that money? Do you want to look at how it's managed? And, you know, you have a professional money management there. They pass probate with no fees, and they have death guarantees as well. So that's really for business professionals to understand. And when you look at GICs, bonds, stocks, investment funds again are mutual funds, segregated funds, and ETFs. They all go into different vehicles, and these vehicles are registered education savings plan, registered retirement savings plans, non-registered TFSA, and permanent insurances. The only difference between all of these accounts, you can have any type of investment in them, is how they're taxed. So registered education savings plans are actually taxed at your children's marginal tax rate. Registered retirement savings plans are registered at your taxable rate, and non-registered is half tax. TFSA is no tax, and permanent insurances, the investments that you put inside of them, they're no tax. So you always want to make sure that you understand what each pool of money represents for you, how it works for you, and sometimes some things work and sometimes certain things don't work for you. So always talk to a professional. And when we talk about wealth building, I always like to add this slide in. I know we're kind of short on time today, so we couldn't do a full breakthrough, but this is a wealth management strategy. I know a lot of people that are not fans of RSPs, but RSPs have their benefits in a lot of cases. So for example, a lot of people, they contribute $5,000 in RSPs, not only personally, but they have work matches through their work, defined contribution pension plans, defined benefit pension plans, and say the contribution adds up to $5,000. Their potential return is about $1,500 from that, say for example, and most people will spend it, and their net invested money is still $5,000. But say for example, you contribute $5,000 from all the same places, and this time you get $1,500 back. But this time you keep that $5,000 in RSPs, and you take that $1,500 and you put it in a TFSA. Your net investment is now $6,500. And for individuals who have capital gains, that have different situations and are scared about saving for the future. Say, for example, they take something called a RSP loan. So it's a particular type of loan given just to buy RSPs during RSP season. So check in with your financial institution if it makes sense with you. Check in with your accountant and your financial professional as well. So say, for example, you have $5,000 and you take a RSP loan for $2,500. And this time you get not only $1,500 back, but you get $715 from that $2,500 RSP loan you took. And now your net return is $2,250. And now what you have invested is $7,500. So year after year, if you start using wealth management strategies, they work for you and they work in ways that you can build your wealth. So look at what strategy might be best for you and what pools of money that you want to access. And questions we get asked a lot about, and I know I squeezed this one in out of context almost, is what about my bonus? So a lot of people work jobs where they get work matches. I know I mentioned it earlier, defined contribution pension plans, defined benefit plans. And this is where your employer contributes amount of money to match how much you're putting into a RSP pool to save for your future and reduce your taxable income. So RSPs reduce your actual taxable income. So if you have a bonus, sometimes some people have a work match and they'll get their bonus. So, and if it's a large portion, what do you do with it? So what you can do is you can do a direct RSP contribution, and it could get paid instead of paying it out as a bonus. So when you take it as an actual income amount, it actually is a taxable amount, which Michelle can explain a little bit more about. Instead of taking it, you can put it directly into RSP and get the return back, and then you can use it towards yourself and grow your retirement plan and put it into a TFSA. So it's always about what strategy you want to take and understand where those bonuses are. Does it make sense for you? And I know a lot of people who take it out as cash, it doesn't always make sense. So I have a quick example here, then we'll be wrapping up pretty quickly. So say, for example, you have assumption of $1 million that you need at retirement, and you have that sitting in investments, but you're actually spending $100,000 per year. Inflation, the rate at which cost is rising, is about 2%, and your investment growth is about 8%. So this is how all these pools of money work. So say, for example, in RSPs, I have $1 million and I'm taking out $100,000 each year. I'm actually going to be taking out $140,000 to do that, to be able to, $142,000 to equal $100,000, because RSPs are fully taxable. So the more money I take out, the more of it's taxable. So say, for example, I have an open account, that money is going to last me 11 years because I need to take out $121,000 to equal $100,000 for my yearly amount that I need. And that's going to be half tax. So those are open accounts. And say, for example, I have a TFSA and I'm going to be taking out $100,000 every year from that $1 million. That money is actually going to last me 15 years in retirement, because money is still growing as I'm pulling it out. And $100,000 in a TFSA account is $100,000. So what you're doing is you're actually growing your money while you're still taking it out. And say, for example, you have $1 million sitting in a permanent insurance policy, and you take that $100,000 out, but you're actually borrowing against it. So you take something called a collateral loan, and that $1 million still stays intact and still builds while you're taking that money out. So that's where you can really get your money growing for you, is where you're leveraging the different options and the different pools of money that we're capable of doing in Canada. So now we have a Q&A time. I want to remind everybody, thank you for attending so much. This is Michelle's information. Don't forget to contact her. Also in the information on the site, it's also there as well on this webinar. So absolutely amazing. I think we missed a few things that we said we were going to discuss, but it's always okay. So Michelle, I actually do have a question. So as some people might have saw, when you were talking, I was actually having my head down because I was managing questions at the same time that were coming out on the Public Allies platform. And we had some questions, and one of the questions I actually encountered today was an individual moved from a different country where the tax rules are very, very different from they are in Canada, and she's finding it very overwhelming and very confusing. So she is a professional, so she's getting some payment from some companies, but other payments she's receiving as contract work. So she's signing contracts, she's not sure what to do. And then she has some freelance work that she's doing where parents are just sending her money for helping their children with certain things, with babysitting and all of those kinds of things. So how would she go about all of this?
That's a really great question, NERU. I would say the first step is probably to look into registering as a sole prop. So it sounds to me like in addition to having employment income, she has two other businesses or two other sources of income. And since she's not getting a T4, there would be two steps that she needs to take. Number one, to register at least one of these businesses. And the reason I say at least one of them is because for one of the businesses, she can use her legal name and then she doesn't need to register. For the other one, she would probably need to use a different name than her legal name and then just go online on the Provincial Ontario website. You can register, I believe it's about $60. And then it's on the spot. You can get a certificate. And then the other thing that I would recommend her to do is to keep track of all her invoices to make sure that she actually records an invoice in the system for each payment that she gets from clients. And of course, she can start deducting expenses that she has, business expenses that pertain to each business separately. And then the last step would be to report all the income on a T2125, which we covered initially while I was talking about the personal tax returns. There is another option to register a corporation, to incorporate, but that really depends on her income. So that's something that we would need to look into separately and make that decision if it makes sense for her.
Definitely. And I think that for a lot of individuals, when they're moving from different countries, it's hard to figure out the tax situation here. So another question we had is, what insurances are good for businesses? There's several different types of insurances that you can get. A lot of businesses, I tell them to get personally protected first. That's your major concern. And then you want to look at protecting your business through disability and protecting yourself through disability in case you get hurt or sick. So you can turn the lights on. And when you have a corporation, you can get corporate insurance, which is absolutely amazing. It builds in a cash value as well if you get the permanent kind. And you can also, if you own a corporation or if you own a business, you can buy certain types of insurances that you have access to called key employee insurances, key person insurances, and those protect you in case somebody in your business passes away. That's very key. For example, restaurant and your head chef. So corporations do that with a lot of their head management. And you can also buy critical illness insurance for your employees as well. So say, for example, somebody ends up getting sick, you buy critical illness insurance in case they get any major diseases and they're unable to come to work. That time you can hire somebody new, and the time that it takes to train. So there's lots of options out there. It's just what your business specifically needs at that time. But personally protecting yourself is for everybody out there. So I think those are all the questions that we have and all the time that we have today. Thank you so much, Michelle, for coming on the platform. It's so much good information. I was taking notes myself as you were talking, and much appreciated. Thank you so much for coming out. And thank you to our viewers for tuning in week after week while we give you more information, more education, and different and unique topics. So signing off from us here, Public Allies, it's Neeru Padmanabhan and Michelle Herscu. And next week, we're going to be back with a roundtable discussion on paranormal activity. I'm actually looking forward to that one. It was requested, so we said, let's make it happen. So signing off. Have a great evening, everybody.
Thank
Bye.
you. Thanks, Neru. Thanks, everyone. Bye-bye.